It's my pleasure to welcome Harry Dent back to the show. He's been on many times with us, and as you may know, I discovered his work back in 1995. I've been a fan ever since. He really looks at the demographic side of economics, which I think is a very powerful way to look at big macro trends. And he's here today to talk about what is going on, and there is a lot going on with bubbles popping everywhere we look. Harry, welcome back.
Good to be back, Jason.
It's good to have you always, always. So, we were talking off air a little bit, and you were on just a couple of months ago too, about how this bubble was a bubble that was going to pop anyway, right?
Yeah.
This is coronavirus is just sort of an excuse, or maybe it's cover, right? For that the inevitable to happen.
Yeah, well, I'd call it the perfect trigger, Jason, because this is one thing. I mean, they can do massive money printing and fiscal stimulus and stop a recession in its track. They can stop a stock slide or crash.
Yeah.
And they did that in early 2009. All this money printing and stuff does not stop the virus. It cushions the economy from the virus.
Right.
So the virus is perfect in that it causes a sudden shock, not a gradual one like a recession naturally building, where, okay, the economy weakens and then more businesses default and lay off and then it weakens more. No, we're in a depression right now.
Yeah.
Probably, officially 14.7% unemployment, probably really, or to be 20%. GDP is going to be down, I think it was down 6 or 7%. The first quarter is going to be down, could be 20% or more in the second quarter. And that's just temporary. That level won't last. But this is depression. You have to go back to 1930 to 33 to find unemployment and GDP drops and things like this. So it's a big hit, but it is temporary. And I was, Jason, it was very late. It was the third week in March when the markets were, just had bottomed and thought this virus was just going straight up. I said, no, if you look at an S-curve progression at the daily deaths and cases instead of the cumulative, it's already starting to decelerate. And this virus, by early to mid-April, it's going to be obvious to the world that this thing is going away. Now it's held up more stubbornly than normal, but that was what caused the markets most to bounce, because you got to remember my key date. I think it was March 16th. That was a Monday after 3 days of the Federal Reserve announcing the most aggressive stimulus program, $5 trillion repo line, not just a couple hundred billion, and 750 billion of extra money printing and bond buying and buying junk bonds and everything, and a bunch of other stuff and some fiscal stimulus. Monday, the market opens up, it drops 15%. The Dow dropped, 15% in one day. The market said, hey, been there, done that, okay? You guys have been printing money for 11 years, and we're in this big a crisis. So it was seeing the virus turn around and could see that, hey, this thing is going away for now. So we're in a bounce. And so I tell people the focus is to understand this virus is a trigger, a big trigger. And we are in a shock that's going to cause deflation. I'm wondering right now, I'm telling the gold bugs and people following gold, why is gold going up? Oh, yeah, infinite money printing. But what about a deflation shock? What if prices go down 5 or 10% on the next CPI report a month from now? You think gold's going to go up with that? Gold hates deflation and loves inflation. So I think everybody knows this is bad, but it's going to be more shocking when you actually see the statistics and see the impacts. And I'll give you a quick example, Jason, because I went through in Puerto Rico. Well, I moved here 4 years ago for all types of reasons, and really happy I did.
Right.
But we got to hit the worst hurricane in 90 to 100 years. We had a 3-month shock. I mean, electricity was just mostly out. No cable or TV. I couldn't even watch CNBC for crying out loud. no internet most of the time. Cell phone only worked on my 17th floor. As soon as I hit the ground, that didn't even work. So my wife and I had to escape to New York for 3 months. So we had a thing like this, a dead economy for 3 months. And guess what? Did we have a V-shaped recovery? No. It was U-shaped. And so that's what this is like. And what I noticed real simply, particularly small businesses, I had 21 restaurants within walking distance. I mean, literally a block and a half walking distance.
How many reopened?
25% of them never reopened. And so those jobs with them, and of course, tons of other businesses like that as well. So people don't get that either. There is no going back to normal here near term, or even in the next few years, for major industries like travel and major entertainment. I mean, I was supposed to be in Australia right now on a 5-city tour for 2 weeks. No, I'm now doing, next week, I'm doing a full day online live stream. We've never done that before. We're probably going to have 4,000 people on that. More than we would have gotten at the live seminar.
That's a great point. Okay, so let me stop you there. So I agree with you. I think we are going to come out of this into a much smaller economy globally, not just the U.S., but every economy is just going to be smaller. I think people are more interested in a simpler life. And I think we're going to kind of go back to basics a bit. You know, when I think of the Depression, I think of that show I used to watch the reruns of when I was a kid, The Waltons. Of course, you remember The Waltons, right? And that's my picture of the recession, or the Great Depression, back in the 30s. And you know, I just think we're going back to basics, and a lot of these industries just will never recover. You can't run a restaurant at 25 to 50% capacity with social distancing. You can't run an airline.
Experience. No, it takes most of the fun out of it,
and not to mention the economics.
Cruise ships will slowly. Cruise ships will take years because cruise ships are in a very good demographic, older boomers who are sick of the stress of real travel, and all that sort of stuff. So, but the thing is, though, still longer term, I mean, a few years from now, first of all, we have a big crash to go through, so that's a whole nother topic. But people earn and spend about the same amount of money. They'll just shift it to other things, quality of life. And I tell you, I think a lot of people realize, my gosh, why do I go to work every day? Maybe 2 weeks a day, a week, 2 times a week is worth it for my business. And then I can have more time at home, don't have to dress up much, more time with my kids. But we can spend more money on other things. And I've had this thing in tour. I've tried to convince my promoters in Australia for years. They say, Harry, you gotta go there live. It just doesn't work. We're getting more people on this webinar than we ever got live at a fraction of the cost. So
I totally
people
agree.
do business better. We're going to get better because of this. I always call it like the Great Depression, any recession, the pause that refreshes. Anytime things go wrong, it forces us to think different or reevaluate stuff. And guess what? We get smarter. We don't get dumber. We get smarter.
We get more efficient. So, you know, every time there's a war, and this is essentially a type of a war we're living in now, we create new technologies, new efficiencies, or at least we accept them. And now people have accepted, you know, online meetings, whereas before they just wouldn't adopt them. And so all of those efficiencies that are being created are going to stick with us. And that's a good thing. I mean, Harry, if you don't have to fly to Australia and waste all those travel days, you may want to go to Australia.
Jet lagged a week each way.
I know. Yeah, so it's a lot. You're going to be a lot more productive sharing your knowledge on that live webinar, and then you'll be able to do other things and create more value in the economy by not moving around. Moving around.
Yeah. The truth is, like, here's an example of simple economics. I'll make half as much money doing this online in a tenth of the time, not even a tenth, which frees up a lot more time to do other things that I can charge more.
It's a better deal for you and your audience.
Alone is worth it.
It's a better deal for you and your audience.
It is.
And the promoter.
It's a better deal for everyone.
Absolutely, yeah.
And you know, people always, you know, it's my biggest criticism of central banks. I call them academic economists who've never had sex or run a business dictating what happens in the economy. They think we should always grow. What's wrong with these people? Can you function without going to sleep 6-7 hours a night? Try it for a few nights. You'll be turning in your mother to the Nazis. Okay? In a simple interrogation, you'll be so out of it. The body I mean, the economy needs to rest, innovate. We do innovate when things go bad rather than wars cause the greatest innovations, the deepest recessions, depressions. I study innovation. They always come at the most challenging times, and then they get adopted in the economy in the more benign times. It's a natural cycle.
Right.
Grow and do maintenance, repair,
and reset,
and restore.
Yeah.
And transform and boom and bust and inflation and disinflation. These are natural cycles. The economists want what everybody wants in life, a zip line to heaven. We just grow, get better, go to heaven and stay there forever.
Yeah.
Okay, maybe in heaven. Doesn't happen that way on earth here. So this is a huge, I go as far to say, Jason, most economists and particularly central bankers have no clue of what actually drives the economy.
Right. Yeah.
In fact, what do they focus on? Governments. Governments are 20% of GDP, and they're the lagging edge of the train. They're not the locomotive in the main part. Consumers drive 70% of GDP directly with their spending. Business capital investment to gear up to meet their growth is the other 10%. That's 80. Governments 20. And consumers and businesses are the leading edge. Government's the lagging edge. Why is everybody studying government policy?
Yeah.
Right now, it's a big deal because what are they doing? Reacting to a problem.
It's never proactive. Yeah, right.
So why would you look at the government as any sort of leading indicator unless it's a dictator who can do whatever they want, whenever they want?
Right. Well, because people just have this odd, unusual faith in government, that government's going to rescue me, this cradle to grave mentality. It's totally unproductive. It's ridiculous. It doesn't work.
But whether it's good government or not, they still don't drive the economy.
Right.
And so I look at people. That's why, you said demographics was my specialty, although I do a lot of other cycles. Technology is the other big. Demographics, when generations grow up, become more, they don't just spend more money, they become more productive at workers at the same time. It's a win-win. Right. Supply and demand expand in a boom. I can tell those booms in any country roughly decades ahead. It's a predictable thing.
Sure.
Numbers of people born, add in immigrants, I can adjust for that. When will they spend the most money in the highest number? Piece of cake. I can tell people when every country in the world is going to peak in their overall spending. And you know what? China is done.
Yeah. Right.
India's just getting going.
Yeah.
People think India will never be the next China. China won't be able to keep up with India.
China's not going to be the next China.
No,
and you know what? I want to ask you
China.
about that because we've talked about that before. I think this is your 11th time on my show, and it's always great to have you. China's one-child policy has really set in motion a future demographic disaster. What years does that hit? I want to say it's in about 10 to 15 years that they really start suffering.
Already hit.
Oh, already.
2011 was their peak workforce ever.
Okay.
It's been declining ever since. It'll continue to decline for decades and decades. China doesn't have immigration. People don't move to China.
Right.
Chinese move out of China, particularly rich people, to get their money out of China because it's not a trustworthy government.
Right.
It's not a democracy. So now the other thing, though, China's done something worse than that. That was way in the past, okay? They've tried to lighten up on that. Guess what? It hasn't done any good. Once people get urban, they don't want to have kids everywhere in the world. China's done something worse. They've created the biggest top-down over-expansion. They've driven urbanization a lot faster than normal progressions that's easier to tolerate. They've got excess capacity in industry across the board. 20%, 22% empty homes in cities, condos, 22%. Yep. And at the same time, engineered by the government, they got the highest priced real estate compared to income in the whole world.
Yeah. And guess what else? People are afraid to live.
That's a bigger disaster than their demographics slowing.
And
the biggest debt bubble in history about to crash.
Right. And people are afraid to live in high density areas now. So, if you've got to be in an elevator.
They got the most of them of anybody in the world.
Yeah. If you've got to be in an elevator or mass transit, those are the two biggest danger zones, according to me. And social distancing is the new normal. So it's going to be interesting for sure. Harry, you mentioned gold earlier, and I don't know if I've ever talked to you much about. I'm just kind of curious your take. I have a feeling I know what it is, but I won't say it. I'll let you say it. What do you think about cryptocurrencies, Bitcoin? What are your thoughts? What does Harry Dent think about that? I don't know if we've ever talked about it.
Well, slightly different things. They're supposed to be the same, and crypto could eventually be the digital gold as a standard for money, but they're nowhere near that. Okay. Number one, I'm going to start with Bitcoin and cryptocurrency. They're in what I call the hype phase, the same place the internet retailers like Amazon and the new .com. All those surged at the very end of the last tech bubble between late 98 and early 2000, gave it most of its oomph. Companies valued AOL, which actually had real sales and earnings. Right. Most of them had none.
Right.
It's valued at 400 times earnings. I mean, that was an impossibility. Yeah. And
look at Zoom with no now. Sales. Zoom is about there. Yeah.
Billion-dollar companies with no sales or very little sales and losses. So that's the hype phase. Hyped up, and then they busted 95%. Tech stocks went down 78 in that big crash. They went down 95. Crypto's the same thing. They've had a great bubble, bigger than the internet bubble, not in capitalization, but in size of the bubble, but up there. And I think they're going to crash. You don't know that the crypto's gone through this hype phase, Bitcoin and all these companies, until you see a lot of companies fail, like the internets did in the early 2000s. Yep. That hasn't happened yet. So I keep lecturing to crypto conference. They say, oh, Harry, if you're right about this big crash, just going to usher in the digital currency age. People are going to not trust currency. I'd say, after that, after that, you guys are the biggest bubble and you're going to burst the most. Now, what did we just see in this crash? What went down more than stocks? Bitcoin. Yep. Stocks went down 40% at worst. Bitcoin went down like 50-some%. Gold did what it did in 2008, went up. Now, I'm talking just the early stage of this crash, the first several days, went up a little bit. Oh, money printing, And then when the crash hits, it goes down 12%. Gold ended up down. It was not the hedge to the stocks. What went up? Treasury bonds. What I've been saying, highest quality long-term bonds, like the falling interest rates, the deflationary side, and don't have default risk like a lot of corporate bonds do. So crypto did the worst, and I've been telling the crypto people, you're going to have the biggest crash when I'm right, and then you'll be the next big thing. Because internet had the biggest crash. Amazon went from 6 to 166, back down to 6, and now to 2,400, 15 years later. Yeah. Greatest boom in history. I mean, one of the, internet was the next big thing, but it had to go through its shakeout first because it was mostly baloney.
Yeah. The pets.com sock puppet and all the web
van. So gold is not the safe haven. I'm sorry. It's not the worst place to be. In the first crash, it only went down half as much as other commodities. It was down 45% when other things were down 70, 80, 85 for oil. Next time it's going to be down a little more. My target's 950 to 1,000. That'll be a lot better than silver and other metals and other commodities. They'll be down 80% plus, but it's not going to be your hedge. Why? Gold correlates with one thing and better than any other probably investment in the world. It's easy to buy. Inflation.
Yeah, sure.
Gold likes inflation. The gold bugs are stuck on the last crisis from 68 to 82 when we had inflationary recessions. Inflation up, economy down.
Yeah, stagflation.
That's right in my summer season for the economy that was predictable to happen. So here we have a deflationary. Why are they printing all this money? They have to constantly print money to keep the economy from falling in deflation. Deflation happens when asset bubbles burst, like stocks and real estate, where people have a lot of money tied up and money disappears, and when debt fails and is restructured, which is another way money disappears. When money disappears, less money chasing the same goods and financial assets, everything goes down.
Sure.
Financial assets the most, but consumer prices go down as well.
Right.
So gold is going, I think, keeps edging up, while bond yields are going down. Bond yields are going down after this recovery from the crash, saying, oh, I see weakness from this virus thing, and it is going to be very U-shaped. Stocks are now finally getting some reality. Oh, yeah, what were we thinking? We're going to go right back to normal. I mean, stocks on the NASDAQ got near its highs, 8 or 9% from its highs. That's absurd with what's just happened. So stocks are going down. Gold's still edging up, thinking, yeah, but they're going to print. But gold's got to remember, 12 to 13 transition. Print. Japan was the first to go to what I call unlimited, just printing off the charts. and inflation kept going down. The gold bugs finally had to admit, oh my gosh, money printing doesn't necessarily cause inflation. Oh my God, Milton Friedman was wrong when he says it's entirely a monetary phenomenon, which I've been saying for years. So I think that's what's going to happen here. I think gold is going to follow bonds. If I want to look short term at the economy, do I look at stocks, gold, or bonds? I look at bonds. Bonds are the most sensitive to short term risk. The bond market is saying, I see things going down. And in fact, I just got a chart from a friend in Australia. The 30-year Treasury bond, the speculators, not the commercial, not the smart money, the speculators, the broad investors are the most bearish on 30-year Treasury bonds, which says they think inflation and interest rates are going up. That tells me it's going the other way.
Harry, I want to ask you.
If it goes the other way, gold is going to do poorly.
If money printing does not cause inflation, and Friedman's statement about it's always a monetary phenomenon, we all know that very well, then what does cause inflation?
Okay, first of all, the primary cause of everything I look at is people, not government policies, short-term and reactive.
Birth rate,
you know what caused
amount
the
of
greatest
children,
inflation in history? Baby boomers entering the workforce. You know how much it costs to raise a kid? And how much
$250,000.
Yeah, $250,000. Governments have to fund education. That's part of their budget, as well as other things. And the last people to invest in these people are businesses who hire them when they don't know their ass from a hole in the wall, okay? And they're 18 or 20 or 22. They need an office, they need equipment, and they need training. I have an indicator called workforce growth on a 2.5-year lag that is the best correlation with short-term and long-term inflation, people entering the workforce at great expense. 2.5-year lag because it takes about 2.5 years before they start to produce more than they're costing to those last businesses that invest in them. So that's the prime cause. But for short-term inflation or money creation, there's two ways to create money. And this is important. I had two great economists, and they disagreed on this. My two favorite ones, David Stockman and Dr. Lacey Hunt. They're both brilliant, but they disagreed on one thing. Lacey Hunt was saying, hey, the only way to create money, Milton Friedman style, is banks multiply bank deposits. We deposit money, businesses, banks can lend 10 to 1 against that, only pledge 10% of our deposits, by the way, not their deposits. And that multiplies money. So in a normal economy, that's how it happens. Economy's good. Businesses and consumers want to borrow money to buy things, houses or business capacity. And then money multiplies with the multiply factor. And then if those loans keep being paid back, it continues to happen. That is where that sort of expansion can cause consumer price inflation. Now, what has happened since 2008 and 9, we had failed demand. We had a excess capacity, a downward economy. Nobody wanted to borrow. Putting interest rates at zero did almost nothing. So what they did was they printed money and put that money into buying financial assets. Now, they tend to buy treasury bonds and asset-backed mortgages, which are treasury related, but that doesn't matter. New money printed out of thin air is coming not into the banking system or to consumers or businesses, as it is recently, into financial assets, more money chasing what? The same assets, which includes stocks, and everything, and gold, and even real estate, and real estate investment trusts, and all types of bonds. So what we've had, the gold bugs were saying, oh, this money printing is going to create inflation. No, it created financial asset inflation.
Right, so asset inflation versus consumer price inflation.
Asset versus consumer inflation. That's the bubble.
Right.
That's the bubble, and it's huge. You can't compare this to the 1929 bubble, which was primarily stocks. People didn't speculate in real estate because you couldn't borrow. So this is a whole nother thing. What's going to kill the Fed? I had Ray Dalio, the most successful hedge fund manager in all of history, stand up and say something stupid, you know?
He's been saying a lot of things lately I don't agree with, but yeah, go ahead.
Yeah, he's saying, I'm not worried about that. He's saying we're at the top. He said he's got a 6 to 7 year debt cycle and a long-term 75 to 100. Well, I've got one too. It's called 90 years. I'm much more accurate about this. 90 years, right down to it. He said, but I'm not as worried about this crash coming off this bigger cycle because the debt ratios are not as bad. I said, Ray, this is not the problem.
Mm-hmm.
The biggest financial asset bubble, how much money just got trashed by one stock crash globally? About $20 trillion. That's 100% of U.S. GDP.
Right.
That's 25% of global GDP. Disappeared in 5 weeks.
Evaporated, yeah.
So these asset bubbles can deflate, which means money disappears much faster. For debts to deflate and deleverage, you got to go through Chapter 7 or Chapter 11, and that takes some time and blah, 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 blah.
And we're going to see a lot of that.
The ultimate monster.
Right.
This is way worse than the debt bubble, which was the primary cause of the 29 crash. This is a financial asset bubble that is absolute bonkers. Mm-hmm. And people are treating me, every time I interview some mainstream economist or person, they're like, Harry, you're crazy. You just predict extreme stuff. I said, you think I created this extreme period? This is the greatest bubble in history, and bubbles burst faster than they build, greater than anything else in history. I'm not creating this. I'm just reporting on it. They're acting like I'm the crazy guy. I'm one of the few sane people on earth right now. Warren Buffett doesn't see a problem with this crap. Mm-hmm. What does that tell you? Warren Buffett says everything's okay, except he's not buying stocks right now.
I know he's sitting in cash. Hugely. Very interesting. You know, Harry, we got to wrap it up soon, but you've talked or written a lot in your books about, real estate and migration trends and things like that. And I remember a long time ago in one of your books, I read about Ashland, Oregon, and you talked a lot about that and how that was going to be a hot spot. And I actually traveled there just because I was like, I got to see what Harry's talking about. That's how much influence you have. I think there's going to be a major migration trend out of these high density living environments. And I'm calling it the rise of suburbia. I think suburbia is coming back in a big way.
Well, I call it exurbia. It's like beyond exurbia. I mean, Bend, Oregon, and what was the name of this? Ashland.
Ashland is what you talked about.
I mean, they're far away from a major metro center, but you can still get there and fly easily, quickly. Mm-hmm. In this online world, which we've just been kicked into deeper. Mm-hmm. I mean, look at me. I'm in Puerto Rico. Now I'm in a city of 2.5 million, so I'm not in the sticks. My island property is in the sticks. Okay, 30-minute flight from here, but I can do business from here.
Right. Everybody can. That's the thing.
So why would you want to live in a place like Ashland, Oregon? I've got a good friend in Miami who is a real estate kind of developer and speculator. Mm-hmm. He moved there to take over his mother's house, and he and his wife stayed.
Yeah, right.
Much better lifestyle, much affordable. They stayed. They didn't go back to Miami after going there.
Stayed where? In Puerto Rico?
Ashland.
Oh, in Ashland. Okay.
Ashland,
and I was just using Ashland as an example. The Ashland's not the thing; it's just an example because you wrote about it years ago. Like 20 years ago. But this idea that people do not need to be in these big cities anymore. Right. They've always had this attraction, and now both employees and employers have realized they can make the work at home thing work. The remote work thing does work. I mean, listen, we've done it for 8 years. We gave up our last office in Southern California 8 years ago. And, it has advantages and disadvantages. But most of our people, they love working at home. And now you can get a better workforce because it doesn't matter where they're located. It's geographically independent. So you really have a bigger pool of candidates to pick from.
But there's a bigger range. Yeah. For me, I'm in San Juan. My vacation place is a 30-minute flight, 60 miles away, okay? Yeah. I'd go there on vacation. I couldn't live there. I'd be bored to death. That is more remote than Ashland, Oregon, as far as a small town and nothing to do. Yeah. So I have the city life. But like you say, even if I wanted to be in New York City, why would I need to go to work every day into an office and dress up and get on mass transit and waste all the time? Why not I do that a couple times a week and then work the rest of the time from home? So I want to be in a big city.
The hybrid model.
Because I want all the restaurants and activity. I don't need to be in a big city to work.
Right. But if some of that evaporates, the Broadway shows evaporate, the restaurants evaporate, and the cost of living and the taxes are still...
Why be in New York City?
Yeah, there's just really not a compelling reason to be there. So So I think suburbia is coming back. So the question is, if you're a real estate investor, which will be the stronger trend? The smaller economy that we're coming into and the economic hardship we're coming into, and we've already began that, or the migration of people with a lot of money to spend out of these expensive, densely populated areas into suburban properties, and that's what our people have been investing in. I think it's going to be a pretty good strategy, and it's America's going to be on the move. The world's going to be on the move, but the rest of the world doesn't have.
I mean, the bubble alone dictates the greater the bubble, the greater the burst. Where's the most bubbly cities?
Right.
Manhattan,
Yeah, sure.
San Francisco,
Yeah.
San Diego,
Vancouver,
Miami,
San Diego,
Vancouver,
yeah.
Toronto,
LA,
Sydney, and Melbourne in Australia, the densest cities. So they go down the most, and yet, particularly wealthier people are going to tend, at least some of them are going to migrate out, and that's just going to feed that downturn more. Another sector that's going to get killed, always does, commercial real estate.
Oh, yeah.
People are emotional about their real estate and don't sell their house, or businesses will abandon a lease or sell an office building overnight if it makes economic sense. So commercial always gets hit harder. So high-end real estate, commercial gets hit the hardest. McMansions get hit harder than everyday suburban home. The everyday suburban affordable home is both attractive now to the new millennials coming up, the new wave, who still haven't bought a lot of their houses yet because they haven't been able to afford to, and retiring baby boomers who don't have the kids and want to downsize. They just need a 2-3 bedroom house. And they even less need to be in the city. They can be in a nice, quiet suburb. So those are the best houses to buy in the downturn, the best houses to keep. And I've been working with a guy in Arizona that's training people to take over McMansions when they collapse and turn them into assisted living things, because large houses will be useful for small assisted living facilities in suburbs where people would rather be.
That's probably my friend Gene. I know him.
Yeah, Gene.
Yeah. So the thing about that is I kind of wonder, because the assisted living homes have been such hot spots for high death rates and infection rates, and I agree that the size of that, the smaller home you're in, the better chances you have of survival. But I think there's going to be a trend really toward multi-generational living, which is very common around the world.
Or people may keep a McMansion so they can have their parents in there.
But it doesn't even have to be a McMansion. It can just be a suburban 4-bedroom house, or a house with a casita in the back. Not even a McMansion, just a a nice.
One of the things I see, if you think the way I think, because the high end is so much more overvalued, that why would you buy an everyday suburban home when you can buy a McMansion with 2 or 3 extra bedrooms and a bigger lot
for not much more.
A lot more? I know. And you could house your parents there instead of having them in an assisted living facility. Which costs, by the way, $9,000 to $10,000 from our experience a month.
It's very expensive, and I think the insurance is going to be tough to get on those, because the infection rate problem and just in general the insurance industry having so many problems. I mean, there's a massive wave of claims coming at the insurance industry, and we're going to see a lot of problems with insurance real soon too. So I think multi-generational living, roommates splitting up, getting their own houses.
Two families may live in one big mansion at 20% more the price, but you split that, you're both saving money. So
but that's the opposite of the 2 single people as roommates in a 2-bedroom place. Because now they need that second bedroom for a home office. Okay, and
But all of these are good changes. If we use our real estate better, if we save money on certain things or commuting. I mean, look, and pollution levels have just disappeared from a lot of cities. And traffic congestion. These are the 2 biggest problems in cities.
It's kind of nice in a lot of ways.
This is a big win-win. See, this is why I love change. People hate change. I love change. Change makes things better. It can happen too rapidly sometimes, but this is going to be a good thing. I'm just warning people, as you know, Jason, this is going to be a major shock, more than anybody's ever going to see in their past lifetime, because you weren't around in the early 30s, or going to see in the future. Financial assets, stocks are going to end up falling 80% or more. Real estate in the U.S., 40 to 50% more than last time.
High-end real estate, commercial
Gold
real
is
estate.
even going to fall. The one true money, yes, that's going to fall, and people are going to be in shock. This does not have to happen. These are predictable things. We've got this first crash, 40%, exactly what I predicted it would be. We're in this 4, 5, 6 month rebound, which is typical, where it's choppy and won't go a lot higher, but stocks will hold up in hope. And then we'll fail again, and we'll go into real deleveraging.
Well, and they're being propped up by the Fed.
Downturn.
You know, the stock
Yeah,
market's
if
just
people
being...
don't, if people don't prepare for the next, it's all right if you got whacked 40% because you've already gotten half of it back. You know, to make it a little better. What's going to be the crime is if you don't see this and get ahead of the next one, because the next one's going to be much deeper and longer, and it's going to be a once in a lifetime threat to your financial assets and business, but it's also going to be a once in a lifetime sale on financial assets and businesses and business assets on the bottom if you do get out like Joseph Kennedy, or you do hunker down like General Motors in the early 30s and pass your competitors. General Motors passed Ford forever to become #1 in cars for the first time, and then became #1 in global corporations. That largely was made by its handling of the 32 crash.
Yeah, a lot of hey, the world's first billionaire came out of the Great Depression, J. Paul Getty. So there's a saying,
Joseph Kennedy. He was a multimillionaire bootlegger, came out ultimately a billionaire political dynasty. Same thing. Out of that crash, he got out at the top, reinvested when businesses were selling for 80 to 90% off. That's a sale.
That's what J. Paul Getty was doing. He was buying up oil companies. So,
The mafia made more money than anybody in the Great Depression.
Yeah.
They were loan sharks at 20% with high cash flow from the bootlegging roaring 20s. Right. And then the businesses that didn't pay them 20% and failed, they just took over at the bottom and owned it, half of New York and Chicago coming out.
Well, you know the saying, recessions create millionaires and depressions create billionaires. So we will see how it goes, but I agree with you. There's a lot of opportunity, a lot of good things that come out of this. Harry, give out your website.
Yeah, harrydent.com. So we have a free daily newsletter you can get on to get to know us if you don't already know us. And of course, and we've just split off from our marketing company we used to work with. So we're pushing our whole newsletter with a monthly from me and from Rodney Johnson, my partner, both under the same roof for a very attractive price. So you can get on our full newsletters, but you can be on our free newsletter as long as you want to get a feeling for whether we make sense or not. And I think you're going to find in the next several months we're going to make a lot of sense, because I'm telling you, nobody else is right now.
Good stuff. Harry Dent, thanks so much for joining us.